Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. As well, I am a loan officer, senior director at Old Capital Lending, and we have been doing loans for over 38 years. I am an investor. I started out in single family, got up to 20 units, and the lenders were saying, go away. And I said, no, I'm not going away. You have to build your team, they told me. And I said, no, I can do this myself. Well, I'm here to tell you, you cannot do this business by yourself. You need a team. And that's why I started Zoom at 8 over 5 years ago. We started Zoom at 8, and we've been making great relationships ever since. So if you're new here, this is where we start your Rolodex. And if you're not old enough to know what a Rolodex is, that's like a Palm Pilot or your iPhone, right? Where you can get a list of people to do business with, whether it is an insurance broker, cost seg, property manager. We've got asset management software tonight. So you can build your investor network right here. It's like going to a conference, but you don't have to pay the fees to go. So Charlie, why don't you go ahead and introduce yourself?
Sure. So thank you, Julie, for having me on here tonight. I very much appreciate it. I'm Charlie Rushton. I'm based out of Dallas. I've been a multifamily real estate investor for about 4.5 years. And about 2 years ago, I, along with my business partner, Kyle, we met Colson, who's here tonight, and we took him on as our underwriter for our deals. He's a professional underwriter, and has been doing it many years, and he'll be able to fill you in and give you a bit more background on that in a moment. And as things developed and the relationship developed, we started talking and understanding more about what the marketplaces needed. And along with his connections, we realized that there was a niche in the market, or gap in the market, for syndicators, mediums to small size syndicators that needed reporting tools for their investors and for themselves as well. So about 1.25 years ago, we started developing a piece of software for exactly that purpose. And year or so on, while we've already taken on clients in a beta fashion, we're now at a point that we've got a pretty robust piece of software that can perform a lot of the reporting on a monthly, weekly basis that a lot of investors and operators need, but don't necessarily have and can't access for different reasons. Maybe there's not what is out there for them, or it's not price effective for them. So our model is both customizable as well as we think and believe a lot more accessible to the smaller and the medium-sized investor / operator.
Well, that was fantastic. I could not have made an introduction as good as that. So Charlie, thank you for kind of getting us into the room as we meet up with tonight's industry expert. And it's this community. It's Charlie, it's Colson, it's Kyle. Colson is going to be making the presentation, but wanted to make sure that you all know that Charlie is involved in it as well. So talking a little bit about Colson, Castilla is a partner and co-founder of Ember Capital Partners. We'll call that ECP. Colson and his team serve as consultants, partners, and sponsors in several ventures spanning the real estate space. ECP provides underwriting, capital advisory, deal sourcing, and asset management services for clients through its subsidiary companies called Ember Advisory Services, Ember Asset Management, and Ember Capital Advisory. So Colson began his career supporting a nationwide team of multifamily loan originators for PGIM, Real Estate Finance, as a financial analyst, where he would underwrite over $5 billion in transactions. Following his interests, he soon accepted a role in asset management and acquisitions in a Denver-based real estate private equity firm where he managed $250 million portfolio in industrial, retail, and commercial assets throughout the United States. Among other assets included self-storage, multifamily, and senior living facilities. So Colson got together with Charlie and they put together this amazing software that is so needed in this community. Asset management has a way of not getting education out to investors. These educators, they just tell you go buy these and figure it out. So it's very important that you get a software program that will help you track the success of your asset. But you also have to know from the data what is possible to request of your property managers. Is it possible for them to make these changes? Is it realistic? So I think tonight you guys are going to find this information extremely helpful. And I would ask that everybody go to the right side of your screen and give the speaker view. Well, there is Charlie, or maybe I'm on your screen. I do want to welcome Colson Castilla to Zoom at 8. How are you, Colson?
Hey, Julie, thanks for having me. I'm doing wonderful. Can everybody hear and see me okay? I didn't realize it would be such a thing.
Yeah, it's you're a little bit backlit, but I think we can hear you, and we are excited about what you are about to show us. We took a moment to go through the software. I was completely impressed, as you know, and it is a very robust software program that is like no other. And it's really to capture the data because data drives decisions. So I'm going to go ahead and give it over to you, Colson.
Awesome. Thank you. Well, thanks everyone for joining us today. This is, I guess I'll be kind of running you guys through a couple of case studies, items that we've come across in use cases in our software and our reporting platform. Feel free to, I'll be trying to keep an eye on the chat best I can. Feel free to raise a hand or, okay. Yep. Awesome. So am I enabled to share screen?
Yep.
Perfect.
You're good to go.
Let me take a look here. So I think this one of those, I don't know if anybody else always has too many screens open like I do, but I think I've got it. Can everybody see the presentation right now? Julie, is it good?
You're good to go. Yep.
Awesome. All right. Well, yeah. So Ember Asset Management, like Charlie was mentioning, this is a project we've been working on together for about 1.5 years now. We, when we were looking at, closing deals together, we were starting to underwrite deals together. One, there was just an absolute free fall in the market. Didn't really like where sellers were asking pricing wise. They're like, well, what else could we, be working on here? Kind of identified this this gap in the market, like Charlie was mentioning, just solving for a more robust automated reporting solution. It kind of builds off of some stuff I was doing in a former job, building out dashboards, building out investor reporting, trying to really just keep a pulse on the activity of an asset. Because what we found was, if you keep your eye off the ball for just a little bit too long, you can end up being pretty far away from your initial assumptions. We also can use this tool to inform new acquisitions. We can pull in comp data pretty easily. There's a lot of great applications and use cases for what we're doing here. So I can just kind of jump into it. Our team, myself, Charlie, who is in the call today, and then Cole Bakarian, he's a close friend of mine, works in the asset management space currently and has been helping us through development, is a partner of ours. And then Kyle Hogg, also Charlie's partner in other ventures. We have him on board as well. Helps kind of keep the ship moving along. So the initial question we asked ourselves was the asset manager's problem. When you look at all the way through the space, the reporting that you're given from your property management team, their software, it's this extremely dense set of mostly PDF reports. You may be saving those away. You might even be reading all 150 pages of those and reviewing them on a monthly basis, weekly basis, whatever it might be. But ultimately, you can't really use that raw data. It doesn't have any, there's no ability to kind of filter through it, sort through it, aggregate it, or anything like that. And you're definitely not hand typing those. So what we wanted to do was kind of come up with a better way to track performance, 5, 10, 20 years down the road on a deal. Be able to compare that against, the initial goals of the project, identify any strengths, any weaknesses in the numbers, and just go a lot deeper than you could ever do with these long form PDFs. This is just kind of a sample set of what some of these look like. It's a lot. This is what we were trying to address. This is just a small portion of the reporting that we get on at this point now. We're pulling most of these reports daily in our platform and are working on further APIs to go, even deeper into the weeds on these. But we wanted to give people an out. We wanted to, help our clients get out of this world of flipping through, these huge PDFs, trying to find the right numbers to make informed decisions about their assets for themselves, for their investors, for everybody involved. So what we've done is we have built out a lot of machinery to take that raw data and get it into a digestible format. What I mean by that is we set up automated reporting from these systems to our specific email accounts. From there, we have tools and software that is scraping those email accounts and grabbing all of the files. Those files get loaded through Amazon Web Service and a bunch of other machinery in there, extract all the data, clean it up, and put it into databases. From those databases, we're able to then manipulate that data back and forth between servers to start, performing more like calculations on it, pulling in referential data points from like a year back, a quarter back, just aggregating and reshaping the data. We normally look at the rent roll, T12, pro forma, property management budgets, leasing reports, work order summaries, AR reports, balance sheets, general ledgers. It kind of depends on the platform. We currently work with most property management softwares, but we're kind of picking our way through some of the smaller ones, trying to see if we're able to get enough reporting out of those on an automated basis. But the whole point of all this is we're taking that raw data and we're turning it into intelligence that you can act on. That's kind of what the raw data lacks, is that insight or that actionability that you just can't get out of a PDF. We can do this on a asset level, on a portfolio level, depending on how many deals you have in a certain market. We can aggregate those in our visuals. There's a lot of great things that we can do there. We also have some external tools where we can port that data, that operating data, out of the databases into specific tools like reforecast, sale, refinance analyses, disposition and general analysis, waterfalls, all of that kind of good stuff. And it's great because you just already have it prepared on hand, can very quickly move that forward and get to a point of making a decision. We do a lot of this by putting everything into terms of KPIs, key performance indicators. These are essential for tracking against your budget, against your pro forma, against your business plan in general, seeing how well things are being executed on things that are in your control and completely out of your control. If something's completely out of your control, what is going wrong, you need to be searching through every other aspect of your deal, looking for things that you can control, that you can make progress on to try to get back to where you need to be on your property. These KPIs help us pinpoint specific areas of concern or needed action. We pull down these leasing summaries, these work order summaries. We build these great visuals that we'll get to in a little bit of leasing pipelines so we can kind of see, like, are there bottlenecks? Do we have a leasing agent who just is terrible at their job? And so, you know, that first level of conversion ratio is awful, and that's why we're not seeing any new leases. Or do we have an absolute rock star, but somebody in the back office is fumbling the leases? You know, we can get to all of that stuff by visualizing this data and keeping track of it on a long-term basis. This data, it can be shared with your general partnership team, your property management team, your investors. We do build some white glove reporting for larger clients, specific branded, you know, color scheme aligning with theirs, all of that. Because ultimately, we're completely in the back of your mind. Like, we're not out there trying to make sure everyone understands this is our platform. You get all that credit with your LPs. So we try to make it as shareable as we possibly can. And then, yeah, the data that we collect, we work with your property managers, we work with our sponsors themselves to get all of the loan data, budgets, all of that, to get all of this started. As far as the product that we put together goes, this is our cover page. This is where we kind of keep things a little bit more high level, but summarize the 4 pillars of the property that we see it as, at least the financials, the rent, the occupancy, and the operations. This is what we're seeing here is going to be a more heavily focused value add reporting style. So we're going to be going into renovation premiums, classic unit, bifurcations, things like that. And we're going to be also keeping a close eye on debt throughout this report, just because you know, bridge loans, especially now, require a lot more attention than they used to. Financials report, this is where we're getting into revenue, expenses, net operating income, some great KPIs up top on per unit items, trend lines, and just statistical averages across a period of time, trying to kind of hone in on the trend of things at these assets. The rent report, this is where we're going to spend a lot more time looking on a month-by-month basis, just checking in on average rents, checking in on trade outs, new leases, renewals, and then also really trying to hone in on these renovation premiums that we're achieving. Those can be, you know, what we do is when we take the rent roll, we try to split it out between classic and renovated units. I think we can handle up to like 5 different renovation levels, or building everything out to be able to handle 5 different renovation levels. So if you've got a classic, a prior renovation, a gold level, a platinum level, you know, we can track all of that pretty easily once we get to know the information. We also have some trade out statistics, retention ratios, and rents in here as well. The occupancy report, this is where we're getting into, split out by renovated or classic, and then just all units across the property, visualizing our occupancy as the orange line coming across versus our average in-place rent, the dark blue, and then loss to lease is what's stacked on top of there. That's kind of your visual capture of how under market your leases are, and that's going to be dictated more so at the property level, what they're setting their market rates at, but we do keep track of that so that we can see, you know, like in here where we're closing the gap on market rents, maybe it's time to start visiting with those property managers and tell them, hey, let's go for $25 or $50 bumps this time instead of just keeping everything status quo. Operations report, we start diving into leasing funnels, age receivables, daily delinquency, and unit expirations for 3-month unit expiration graphs, so we can kind of see what units we have coming online over the next couple of months. Conversion ratios, work orders, average days open, new deliveries of renovated units. A lot of great statistics in here, but more on the operational level of the asset. So with all of that, I can kind of jump into a couple of examples here, ways that we are interpreting data using all of this that I just showed you, but I can break there if anybody has any specific questions before I move into some of the more, I guess, open form items here.
So Paula was looking at screen number 6. Do you integrate
Screen number
any data
6.
from the Federal Reserve looking forward?
If we have, we do a lot of SOFR reforecasting, not our own reforecasting, but we typically use the Pensford forward curve for that, because it's just pretty easily accessible, comes in a good usable format. And we do that. We don't really get into any micro or macroeconomic items in the market surrounding the asset. I'm sure there's a future iteration of this where we will do our absolute best and try to do that. But right now we're keeping it pretty specific to the property or any other operating properties in someone's portfolio.
Okay. On screen 7, which I guess would be the next one, can we see a screen example of the KPI that falls out of the norm? And maybe that's something that you're going to talk about.
A screen example of saying that, like seeing something go wrong.
I think that's probably, Paula, is that what you're asking?
Yes, ma'am. Yes, ma'am. And yes, sir. I'm trying to see what the alert is and how soon it shows up, so you can have the time to take action before it goes out of the norm too much.
Yeah, absolutely. So I'll get into that. I'll get into that in the case studies. I do a base case, best case, worst case for each of the ones that we're going to dissect. So
Yes,
great question though. And yeah, we'll be covering that momentarily.
Perfect.
yes, and
Thank you.
also the manpower. I mean, are you interfacing with data that's already on a screen somewhere, or are you having someone on your side or our side put in the data in order to do this?
So yeah, what we do is we work with the property managers. We schedule reporting in the formats we need it, set up the way that we need it. Those get sent out to us at like, I think 11 p.m. every night. And then our software handles everything else. It scrapes the files out. It puts those files where they belong as just raw files, as backups. And then we have another instrument that goes into those files, pulls all the data out and organizes it into our databases. And then those databases flow into the visualizations.
It's wonderful. It's
Fantastic.
amazing. It's a great
All right,
product.
keep going, Colson.
Yeah. Okay, so we're going to jump into a couple of case studies here. Example 1, we're going to be talking about renovation premiums. What sort of what level of renovation premiums are you achieving on these units that you've been renovating? Are you getting an adequate ROI on these improvements? Are you spending $10,000 to get 100 a month, or are you spending $20,000 to get 500 a month? It just depends, but we can capture all of that. So where you would typically get this information is you'd be scanning through your rent roll line by line, looking for your renovated units, taking those rents as an average, and then starting to calculate that against the average of remaining classic units of that unit type to really prove that out. Even better, what we can do is we can filter by lease start date and start looking at, trailing 30-day, trailing 60-day, trailing 90-day new leases, and start seeing some real momentum in what's happening in the numbers by kind of aggregating it that way. Our base case here: steady renovation premiums across the board. You just know that if you have a renovate or a classic unit turn, you can take it back. You can take it offline for, maybe it's 30, 45 days, do your $8,000 renovation, and you're going to achieve I think it's like a $225 premium or so here by the end of this. Very base case, easy to see that just keep doing this. Our strong case, we're seeing that as time is moving forward here, these are also on all these graphs, these are months starting in August to July. So our T1 period is closest to the right-hand axis. Strong case here, we're seeing that this premium is growing over time. The market wants more of these units. We'd start cross-referencing this with occupancy data in these unit types. We'd start really trying to hone in on where is our best ROI for, is it in the 2 beds, the 3 beds, the 1 beds, which unit type should we focus on? And then we'd start forecasting when we get those back, and we could keep our GPR expectations in line with that. A weak case here, we're seeing that, maybe there's a little bit of success here and there, but in general, the market just does not want this renovation level. We're not seeing any real benefit to it. And at the end of the day, we're not even surpassing our classic average rent anywhere on this graph. So this would be a, stop renovations. We would have stopped it much sooner, but for the purposes of this example, we let it go on for an entire year before someone hires us. So that would be a pretty weak case for going in and spending any dollars whatsoever on a property because you just do not have an ROI to be achieved there. Our second example, renovation deliveries. How many units are you renovating each month? Is this number well thought out and optimized, or is your team just pouring capital into improvements because that's what the plan was? And I've seen this I've seen this happen too many times already. It was the business plan. They're not keeping track of the data. Sometimes even, the lender almost requires it. Sometimes the dollars are already being you're already paying interest on the pre-funded CapEx, and you're trying to do anything you can to try to get your NOI up, but it's just not working. To get this data, we're going to be looking at CapEx trackers, unit availability reports, rent rolls, kind of aggregating all of that data, trying to see when you have units coming online, trying to see what your volume has been thus far. And then you're also going to be trying to keep track of that occupancy as you deliver new units. You might just be delivering units into a void. Essentially, you're doing it too quickly and spending all that money pulling down your CapEx and sitting on some vacancy as a result of that. In a base case, here we see, we're getting, what's this, like 19 and then 18 renovated units month over month over the last 3 months. Your occupancy is staying fairly in step each time. Maybe in May when you delivered some of those units, there was a slight dip in occupancy, but then it absorbed pretty quickly. You delivered more units, it swings back down, but it's staying healthy nonetheless. You're not, dropping below 90% occupancy at any point here. A very strong case would be if we're seeing our classic units sitting pretty low occupancy, but as soon as we get a renovated unit out the door, it's pretty much leased within a couple of days. This definitely happens in a lot of markets, and this would be a all hands on deck. How quickly can we get these units turned? Because maybe it was the plan to do 15 a month, but you should really be trying to do 25 for at least a little bit to see if the market will absorb that as well. Because that's just going to get you stabilized quicker. That's going to get you to a tested T3 over T12 NOI or whatever it might be quicker, and you can recapitalize the deal, pull out a lot of that money, or just outright sell it. All about getting to that seasoned NOI so that you can make that exit. That was the plan, and IRR is very time sensitive. So if you can do it sooner, all the better. A very weak case here we see starting in about August when we started taking units offline to be delivered here. We're just seeing a slow, steady decline. We're just dropping these units into a bucket that no one is looking at. We're just seeing units delivered, and it's not helping at all. So this would be let's hold off on renovations. Let's get this leased. Let's start trying to do some more comp shopping, see what's working for other people. But this would be we would be saying let's halt renovations for the time being and let these absorb. Our third example, lease expirations. Do you currently know what your forward-looking occupancy exposure is? Do you know if it presents an opportunity or a risk? We'd be looking in here at our unit availability reports. We'd be looking at lease expiration dates in the rent roll. And then we would also be looking at occupancy split out by unit type of each of your unit classifications, whether it's the ones, the twos, the threes, or the A1s, A2s, A3s. We'd be splitting that out and trying to get a sense of what our trailing renewal ratios are, how long it's taking, average days vacant for these units to be sitting out there, and how many of them we have coming due soon. Also, what are just the trade outs in general, dollars wise. A base case here, what we're seeing in the top left is occupancy by unit type. For this example, we just have 1, 2, and 3 bedroom unit types. We're seeing these all sitting, pretty consistently in your mid 90s occupancy. We have a pretty well distributed load of units coming available over the next couple of months. And our occupancy doesn't really look like it's suffering anywhere. So, wouldn't really dig too much further into this at this point. Everything looks pretty healthy. In a strong case like this, where 3 bedrooms, maybe you have a wait list, maybe you have, maybe you just only have a couple of these and the market really likes these 3 bedrooms. It could be any number of things, but in this case, this is a great opportunity because what we have here is, broken out by unit type. We've got, I guess I need to be on this screen to show this. These colors correlate with the lines up here. We've got 10, maybe 8, and another 8 or so of these units coming up for renewal soon. We would be, ahead of time planning. Okay, let's try pushing rents $80. Let's see if we can get that. Let's look back at, the historicals. What's the highest in the market that we could be, trying to achieve here? We would be, pretty excited by this opportunity to have a lot of these come up all at once, because that's going to help us burn off our loss to lease. That's going to help us in a lot of ways here. As far as a weak case goes, here we have some 2 bedrooms that are lagging behind, and we also have a lot of these units coming up for lease expiration or renewal soon. We might preventatively put a couple of loss leaders out on the market, try to just get some more traffic drummed up on those units, see if we could lease them up to help absorb that impact a little bit better. We might also just offer some renewal concessions on these deals to try to keep as many of those people in their units as we possibly could, because we do not want to take any further of a hit on this unit type. Also, one thing that we're working on trying to incorporate, it's going to be hard, but I think it'd be really cool. A lot of property management systems, if tracked accurately, on-site staff should be recording what the initial contact point was, like what drove that traffic to them, and then we could start analyzing those tenant IDs with their visitor IDs essentially, and then we could start associating different leasing pipeline sources, like maybe it's your Facebook revenue or Facebook ad revenue spend, maybe it's your apartments.com listing, maybe it's your Craigslist listing, and we could try to hone in on what spend is working for a unit, which spend isn't working for a unit. So like in this case, if most of our leases had come from Facebook ads, but we haven't spent any more dollars on that platform, we'd be saying double, maybe even triple down on the investment there, because that's where all these leases are coming from. That's where those shoppers exist, more or less. We can do that by hand right now. I want the program to do it for me before we try to take that too wide. But it's a cool way of looking at things ultimately. Jumping into our 4th example, loan covenants. This is a pretty hot topic right now. Bridge loans, SOFR got out of control. Caps got astronomically high in price. And a lot of people are either just, trying to renegotiate with the lender, trying to make loan modifications. Just in general, it seems like I keep seeing articles about it. Everyone is kicking the can down the road, waiting for greener pastures because they're coming, but it's not today. No one can really refi out of these bridge loans at the moment. Some people can, and that's great, but a lot of other people, you need to be keeping an eye on your extension testing. You need to be keeping an eye on a lot of items about that. The data that we use here comes from the loan agreement, something that we set up in the model at close, or not at close, really at onboarding. We look at the T12, our income and our expenses, and we're also going to be looking at some SOFR curves in here as well. The loan agreement, a lot of loans, every loan's a little bit different and what the testing looks like. We can build that out pretty easily in here. Just up front, we just dictate the period, dictate the test, the math behind it, and it can keep track of all of that as the deal progresses. For this case, we're looking at the debt service coverage ratio. I believe this one was done on a T3 over T6. They achieved their business plan really quickly and are sitting very steadily at 1.5 coverage ratio. They're going to be able to sell, they're going to be able to refi, they're going to be great on this deal. An even stronger case, our NOI just keeps climbing basically the difference from here to here is just more money in you and your investor's pocket at the end of the day. That means your cash flow is growing more and more. You have a pretty low loan balance ultimately, and you're going to be able to exit this deal very, very nicely. In a weak case, here we see that somewhere between the summer months of June and July, something happened at the property. And we slid below that testing threshold. This is where, as soon as we start seeing this trend line dipping down here, our first calls are going to be being made to our lender, or maybe not necessarily to our lender. You don't want to be canary in the coal mine, but we're going to be talking to a lot of people on the team, trying to sort out, looking at the rest of these graphs, what expenses went up, what income went down, and kind of go from there. Try to identify what the issue was. In a lot of cases where we've seen things like this, it was an insurance renewal or a new tax assessment, just absolutely blindsides a team. And those are, fixed expenses. Your lender and you really yourself should require that you have insurance on these properties. And in some coastal markets in the last couple of years, I mean, those rates have doubled, tripled in a lot of cases. I mean, I think Miami's like 5,000 to 8,000 a unit to insure right now. Like, it's just a nightmare. But yeah, so it could be something that's in your control. It could be something that's out of your control. But the bottom line here would be, we'd be looking at, if it's out of our control, we'd be looking at places that we can control, either income or expenses, looking for opportunity to try to bring the numbers back in line with our testing periods. Our last example, I believe here, is the resident delinquency. Trying to kind of get at a question of, are we thoroughly vetting these applicants, or is bad debt slowly creeping up? Something that can be kind of, if you're only really looking at the T12, you're only seeing bad debt when they write it off. Ultimately, you're not seeing that accounts receivable. You're not seeing the true delinquency of the deal. So what we do is, sadly, we're trying to get these numbers out of the general ledger now as well, because some of the newer onboarded property management softwares we're working with don't have these in as good of a format. But basically, it's just daily collections. What amount of your rent has been paid by each date over a calendar month. So we're looking at a lot of data points here, just trying to get a sense of these curves. Trying to get a sense of our aging report. Is there a hidden huge write-off somewhere in the numbers? And do we have any recurring problem tenants that are just consistently late, or are really in need of being evicted? Property managers will be handling a lot of that eviction kind of item here, but we like looking at the numbers because of the trend behind them. A base case, so this is a daily resident delinquency. So what we're seeing along the left-hand axis, this is percent of rent outstanding. So by the first of the month, you've got about 50% of people have paid their rent. As we move forward in time, the line gets darker as well. I'm sorry, as we move forward in months closer to today, the lines get darker. But we're seeing a pretty consistent trend here. Most people make their payments by the end of the month, and it's getting better and better each month as as we start seeing that lower curve. It's getting darker. We're getting closer to where we are today. So getting rid of some of the problem tenants, have more people paying on time. Another cool use case for this curve is, let's say your mortgage payment's due on the 4th. We can pretty accurately say, within a range, how much money will be in that operating account to make that payment. Great for cash forecasting. And there's a ton of other use cases for some of the math behind this. In a strong case, here we have people, really paying their rent by, the 3rd or the 5th. I don't know if any of y'all have ever, looked at a deal that you're underwriting, might be acquiring, and you are like, oh, this deal looks great, but then you start digging through the other income that you've just, initially underwritten to match T12, and you're like, oh, about 30% of this is late fees. Am I going to be bringing in a better tenant ultimately that pays their rent on time, or can I keep counting on $30,000 a month in late fees at this property, or do I even want to count on that? That's something that I see in a lot of deals where everything looks great, but then you're like, oh my God, like these people aren't paying their rent on time, and that's kind of a bad sign in a lot of ways. So this is a pretty good looking curve. We would be pretty happy with this result. Good seasonality or just a good trend overall. A weak case here. We're seeing as months go by, things are getting worse and worse. The darker lines are ending at higher delinquency by the end of the month. We're seeing more of a balance accruing in our 0-30, our 31 to 60, our 61 to 90 buckets. And we're going to be seeing some real bad debt problems here. And it seems like, maybe we've dropped some conditionals on our lease requirements or our applicant requirements. Something's happening. This property is getting packed with bad tenants, and that's a problem that can last a pretty long time in a lot of states. If you have non-performing tenants, some states make it really hard to get them out of your property and get your property cash flowing again. So hate to see this. That's all of my examples. Before I go into the rest of the pitch, does anybody have any questions about those? I know that's a lot, and I know I live and breathe this stuff, so I can just kind of sit here and talk about it all day. But I'm happy to hear from anybody who has any questions.
Well, Paula or Candace usually have questions. So Paula, do you have a question?
Hi, I love the software. I love it. I asked a question about if you renovated, say, 30 out of 300 units in a month, and on month 2, you were supposed to increase rents by 200 per unit. And if you found that only 50% of the renters could pay that, what would your software do? How would they notify the viewer? And hopefully you would call the owners first and let them know before you call the bank. So
yeah, we do not talk to anybody's lenders. We absolutely not. All of our communication is just with our clients. I'm not super familiar though with a lease case where you do the renovations and they're not contractually obligated to pay the additional rent though. I guess I'm just not super familiar with that scenario. Do you mean, is this more on a?
Yeah, this is not usually the case, but say for instance, you have units to lease up and they're not able to pay. Or, just in continuing, we've seen it where people are just not paying. They give incentives to get them to pay, effective rent goes down. And so I'm just wondering what your system does to notify them of that and how soon that would happen.
Yeah, so we would see that. I guess it depends on how they're not paying. If they're not paying an additional premium, or if maybe you've added some, I guess, called it like a lease charge or something like that, maybe an amenity fee or something like that, where there's a base plus situation. We can actually go into, once we go into the rent rolls and understand how, part of what we do is we map the entire tree of accounts for the accounting software that's being used. So we pull down a master list of accounts, and we sort all of that into the buckets we wanted in. We take those accounting codes, and a lot of this runs off of that data. But what we can do is we can look at specific other income line items. Maybe there is like a specific renovation premium or some sort of other income that's happening. In the case where maybe you went in and paid X amount to have like Spectrum Cable or someone like that put new connections everywhere, and you're supposed to be collecting a $50 a month rubs on that, more or less, or cable fee. We can see that in the rent roll. We can code in specifically what those rent roll charges are. We can see the penetration on those fees as leases are turning, and just in general, we can see what the how much of that we're grabbing. That's a big thing that we look at, is just other income penetration ratios, where opportunities might lie there. And then we also would be looking at that bad debt, the delinquency, items like that, to kind of keep track of whether or not tenants are paying these fees.
So in addition to that, if for instance, you had that could be a tech package signed up, or something that they had signed up for once it's installed. I mean, it could be contractual, but that's one way that we can think of. If are there any methods, like over a period of time, say 6 months to a year, when the rents have had a chance to turn over, if you're not able to realize the rents according to your business plan, Does your software give them recommendations on ways that they can increase effective rents that have been tried before? Like giving 1 month and 6 months free or something like that in order to incentivize someone to come to your unit versus someone else's?
In a lot of ways, yes. It gives you kind of the data of what your asking rents are that can be compared against what the rest of the market is asking for. We do not pull in any direct comp reporting in here. Like we're not accessing CoStar databases or anything like that, which also are inaccurate anyway. I hate CoStar. I like CoStar as a jumping off point, but they're never actually right. The best thing that you're going to be able to do there is really putting your operator hat on and going and secret shopping your comps, going and visiting them, touring their units, seeing what's working at that level. But we cannot pull in out of databases like that items that would necessarily relate to like how many dollars or specifically what to do. But everything that's in these reports absolutely can point you in the right direction of trying to see, is it my economic occupancy? Am I getting bad trade outs? It can definitely point you in the right direction of, what might be going wrong.
Yeah, fantastic. Very robust. Candace, real quick, because then we have to finish up here.
Sure thing. So is there a minimum number of doors that you would suggest to have this software being cost effective?
Yeah,
No, that's not good. Is he frozen or is it me?
No, he's pausing.
He's frozen.
Yeah.
Okay.
Oh, can you guys hear me now? Did I break
Yes.
up?
Yes.
Okay. Yeah, I would say about 100 doors is kind of a good threshold.
Okay.
As we get into more doors than that, I think it gets a little bit better. But the bottom line here is that even just the investor reporting capabilities of this tool definitely prove out to be worth it. I mean, just if you start thinking about the time spent aggregating the data to get those out on a monthly or quarterly basis, even that annual report, it's a lot of time saved because we just have all of that data put together for you. And in a couple of cases, we've had people, like they might have like their investor update memo that they want to see. We'll just build a one-off thing that just pulls in those data points organized in a similar way so that we can just print that out at the end of the month and give it to them, and they can just go through and update along with that. So they can keep it in their format, keep it in, what they want, but they don't have to go through all of these old reports and start, pulling all of this together. We just already have it.
That's wonderful. All right, Colson, keep going because we've got, let's wrap up in about 5 minutes.
Yeah, so our approach, we work with people with individual assets, portfolios, a well-timed question. Realistically, if an asset isn't more than about 100 units, it starts to not make as much sense for an operator. What we take on with that at the individual asset level, your monthly asset report, complete with commentary and data analysis, ad hoc data preparation, query and analysis. So that's one-offs like, hey, we got this off-market offer. A friend of mine wants to buy this for 25 million. What will that do to our returns? We can prepare that pretty quickly because, again, we just already have everything on it. We can be there in property management calls or partner meetings, kind of running through the reports, running through what's going on at the deal. Also just, chatting with the property manager is always, a good thing to do. We retain the data on these deals for the lifetime of the hold. And then at the end of it, we can either give the sponsor that, file of just all their raw statements that we used or, whatever else. I don't see any I think like ultimately these files are so small, they're just cumbersome. Like we have like a terabyte or 100 terabytes or something like that of storage. And they're like, yeah, you'll never hit that. Even if you do daily reports for 1,000 assets for 10 years, like you'll never hit that.
Wow.
So no issues on data retention. And then, yeah, we work with your property manager to implement that recurring data feed from the property management software. And then that kind of just turns on the machine. Everything just starts kind of running from there. At onboarding, we can also go back and try to recapture a lot of old data points. It's hard to get everything. A lot of property management softwares, for example, if a unit has renewed at some point, or like a lease has renewed, if you go back a year, it's only going to pull in their current data because that tenant profile has been updated. It'll still pull that tenant profile. It won't. There's some limitations, but we can do everything that we can to try to get historical data in there so we can start looking at period over period trends sooner. For portfolios, larger asset pools and larger clients in general, yeah, we can absolutely work with you to customize our reporting to suit their needs. We can co-brand everything with what they already have out there in the world with their investors, lenders, everybody else. And then, yeah, the whole report, yeah, just gets completely rebranded to match. I'll leave this up for a second. Again, I'm Colson. It's been absolutely great getting to sit here and ramble about this stuff for so long. Love the having the stage here for a minute. You can reach me anytime at Colson at emberam.com. Our website, just ember-am.com. There's a request a demo in the, I think, top right of that webpage. Book a demo with me. I'd love to sit down, talk about your specific needs, how we could help you. There's a QR code also on screen that'll take you straight to it. But if you forget to do it now, ember-am.com. It's pretty easy to get in touch with us. We try to stay accessible. So again, thank you guys. Loved the questions. This has been absolutely great. I plan to stick around for a little bit and continue chatting. But I'll give the floor to you, Julie.
Well, fantastic, Colson. Amazing how we met 2 years ago and never thought that, I mean, when I met you, I was like, this guy is bright, and that you would be putting together the software program that we would be presenting it here. And just so helpful for so many people in this industry, where you can rely on the data that is there and making some decisions upon that data. I would think there is some coaching that needs to go along with this, what can you draw out of this data information and to make those decisions. I think that is also what needs to be part of the program. Just knowing which data set to use to get what information, and then you can pull and make some assumptions. That's, I think, really helpful.
Absolutely.
In this. I loved how you did that. You broke it down and what data set you're going to use to make that information, pull that information. I thought that was amazing. So Colson, thank you again. I appreciate the time you have spent with our group here.